Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jared Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. Welcome to another episode of the Optimal Wealth Podcast. My name is Jared Alexander, and I am your host. I'm also the founder of Optimal Equity Group, which is a real estate investment firm that partners with experienced operators that acquires assets in emerging markets. We primarily focus on value-add apartments and are keen on educating passive investors to make informed decisions about safeguarding their financial future through alternative investments. And today I wanted to do something a little different than our typical format. What I'm going to do is go through my story and how I got involved in the space of passive investing. Really just back to our goal is I just want to help educate others who are maybe just getting started out, and looking to just get their foot over that threshold, maybe just, in that analysis paralysis phase, like I was for a couple years. Or a seasoned investor just looking to help educate themselves and look at, diversifying their portfolio. So before we get started, though, I do ask if you have listened to some prior episodes and have found this podcast helpful in any way, please rate and review the show. It helps us out. And more importantly, share it with a friend, or share it with a family member and someone that may benefit from this that just is not aware. That's the whole reason really I started Optimal Equity Group, was to help educate others on this way, on this alternative way of investing and diversifying your portfolio. Because not a lot of people hear about apartment syndications. I know I had no idea what that meant. All I knew was go buy a single family home, rent it out, get some cash flow, build some equity throughout the hold period, sell that maybe, or just hold on to it and get 40 or 50 or 60 houses, right? It really depends on your goals. And I'm not saying that's a bad thing, but that's all I knew. Again, I never heard of apartment syndication. So we're going to dive into that and just talk about what that looks like. And again, I'm going to share my story, and, we're going raw and real here today. I got some notes and stuff I want to touch on, but, I'm known for going down some rabbit holes and things like that. So we're going to try to keep it on track here, but just bear with me, and hopefully you get some value out of this episode today. Let's even back up, is determining my why, right? I really had to sit down and determine why I wanted to get into real estate. What are my investment goals? What were my family goals and things like that? And my why is I wanted to create more time freedom to be with my kids and my family, my wife, right? That period. That's my main goal. And now what comes along with that, of course, is more time freedom to do what I want, right? Not have to work a 9-to-5 job for the rest of my life, be work optional. A guy like me, honestly, I'm not the guy that can sit still on a couch all day and watch Netflix. Ask my wife, even on weekends, she's just like, just sit down and watch this movie with me. And I'm like, okay, and I got to force myself to do that because I'm just always on the go, right? I'm always looking at the next thing or doing something. I like to keep moving. But anyways, is definitely determine your why. What are your goals and what you want to get out of real estate investing, or really any type of investing at that point. So, mine, again, I want to spend more time with my family, be there for my kids. I started out listening to Bigger Pockets. I had some friends, actually, even backing up, I read the Rich Dad Poor Dad book, which totally changed my whole outlook on my life, my career, what I wanted to accomplish. It was just like that light bulb turned on. Prior to that, I always had an idea. I wanted to be an entrepreneur or get involved in real estate at some point. My grandfather, I saw him retire at the age of 50 off some commercial real estate that he still owns to this day. And he's 85 and he's been living off that income ever since, right? And so I paid attention to that at a young age. My mom's owned some single family homes. So I always had an idea I wanted to do this, but we're taught in school, go to college, get a job, put your money in a 401k, IRA, and hopefully, have enough money to retire when you're 59 and a half, when you can access that money, right? And not saying that's a bad thing, but that's all I knew. And so when I read that Rich Dad Poor Dad, again, just a whole new world opened up. And like I said, the light bulb turned on. And really what that meant for me is I can take control over my financial future. I don't have to put it in the hands of others or hope the stock market, goes well, especially when I'm at that point of retirement, right? At 59 and a half, if that's the route I was going, hopefully my portfolio accumulated what did it need to accumulate for me to be able to live off that income. Going back to, okay, I read the Rich Dad, Poor Dad, whole new world opens up. So I know, hey, I want to start investing in my financial future, start creating some passive income. And now, too, I'm in sales, 100% commission. You can make a lot of money in sales and do really well, but if I get hurt, or something happens where I can't perform and show up at work, I'm getting 100% of zero, right, for the days I'm out. And so that actually drew and kind of going back to my family. I want to make sure my family's supported too. So just getting a plan B, right? A second income to just help replace our, the goal is to replace the W-2 income, replace our expenses, our month-to-month expenses. So we do have that time freedom and be work optional. What I did is I was listening to Bigger Pockets. I knew I wanted to get involved in real estate at some point. And so I actually started out in single family, which I'm sure a lot of stories are similar to this. Is I had a buddy, I'm in Phoenix, Arizona now. So we weren't really finding much that penciled here. In Phoenix, and going based on the Bigger Pockets, you want to do the 1% rule, right? So if you buy $100,000 house, you want that house to be renting for $1,000 a month, is kind of the goal there. And we weren't just finding any of that here in Phoenix. So anyways, had to look out of state, found one in Kansas City, Missouri that penciled. It was about $200 a month in cash flow. Everything was going good. Now, I will share, so whenever I met my wife, I ended up moving in with her. Before that, I rented apartments, I was in rentals, things like that. So I actually never even purchased a home myself before prior to this single family. And now I bought it as a turnkey property. To sum it up, I'm representing myself on this property here. And so it's a 1920s build. You can imagine what's on an inspection report. I'm negotiating all this stuff with the realtor or the company that's selling me the house, and finally get to agree on everything. We get it to the finish line, close on the house, and things were going great for about 3 weeks. And then I get hit with a sump pump bill, right? Which I had no idea about sump pumps. I don't live in Kansas City, Missouri. I don't have basements, right? So I didn't even factor this into the CapEx. Just had no idea, honestly. So $4,000 later, after I had to get the sump pump, some landscaping regrading, I had a water heater, stove, throw in a couple miscellaneous items. I'm about $4,000 in, and what that did is wipe my cash flow out for about 2 years, right? And my goal was, again, to replace my W-2 income. So I'm looking at cash flow. I want to get as much cash flow as I can to cover my expenses, my month-to-month expenses. And when I'm looking at that being wiped out, right? And now, of course, you factor this stuff in. You want to factor repairs in and everything, but within the first month of this happening, it was a big eye opener. Now that still didn't deter me. I wanted to go out and buy 60 or 70 more houses and keep doing it because I had the real estate bug at that point. It got my foot over that threshold. But going back to that analysis paralysis stage this is why I think it's so important. Absolutely. Educate yourself, talk to others. I was going to networking events, listening to a ton of podcasts, again, Bigger Pockets, reading the books. So I was doing that. But once I finally put my foot over that threshold, I was able to be hands-on, and you learn so much more as far as being a part. Now, again, you want to, take educated risk. You want to be smart about what you're doing, make sure everything pencils. And I actually had somebody check my numbers just to make sure, hey, I'm on the right track here. Let me just make sure I'm not missing nothing. But once I did that, I mean, again, who would have thought about a sump pump? Who would have thought about the cash flow getting taken out for 2 years? So I'm learning as I go, right? And honestly, we had that rental property for a year, ended up selling it for a profit. So it's still, and we still made some money on it. Again, it was a great learning experience. But during that time, as I'm looking at maybe buying some other houses, I actually, my buddy Randy, he invited me to this multifamily networking event right down in Phoenix. And so we went to this, and then I start hearing about this term apartment syndications. I had no idea what apartment syndications were up to this point. For those that don't know, what a syndication is where investors pull money together to cover the purchase price, down payment, renovation costs for a specific property, right? So the operator goes out, gets a loan from the bank, either anywhere from 60 to 75% LTV, sometimes 80, but you don't typically see that too much anymore. These are $1 million properties, typically 100 plus units. So, they don't just have that money sitting around for the down payment. So they raise that from investors so they can participate in these deals and get some returns on their money. But we'll go a little bit into that as well and how that works. But so I start learning about this and really what I learned when again, the light bulb turned on with the syndication world is I was spending tons of hours underwriting all these deals for the single family homes. And with this apartment syndications, I can hand my money to an experienced operator. Again, I'm still working the W-2. So, I got a family, I got 2 kids, a wife, right? Like I said, I can't sit still. I sign up for T-ball. Oh, sign my kid up for T-ball. Let's be the head coach, right? Like that's where I'm at. So I just keep throwing stuff on my plate, and which is, I don't think is bad, but just finding the time to do all this and be present, I was struggling. So when I found the syndication world, I can hand my money over to an operator who was experienced, had a business plan in place, brought me a deal and said, hey, Jared, I got this deal. Essentially what you can do is double your money in 3 to 5 years. On a $50,000 investment, you can get about $300 a month, average cash on cash throughout that hold period. Now, this is just an example. Some deals vary. And, I'm thinking, hey, I was making $200 a month on that single family I bought. And I was still having to manage the property manager. I still had a lot of hands-on things that I was doing, even though it was supposed to be passive, right? And so, as I'm learning in this, I'm like, okay, I ended up getting a referral to this operator here locally in Phoenix, and I'll share his name, Rise 48, Zach Happensaw. He's actually going to be a guest on the podcast here in 2 or 3 weeks. But, they talk about find a guy like and trust, right? I scheduled a call with Zach, was on the phone with him for an hour. I honestly, at this point, I just printed some due diligence questions off the internet and kind of went through them, right? Some stuff that made sense to me that I wanted to know. And he did a great job of answering them. A lot of them he answered without even me having to ask. And so I started, okay, I felt comfortable, and I decided to wire my money into that first deal. Now, here's another cool thing a lot of people don't know about is on that first investment, I actually invested through a self-directed IRA. I had no idea. I just thought the IRA had to be invested in the stock market, mutual funds, bonds, things like that. I didn't know I could diversify that out and actually invest in real estate in a physical asset, which is why I like real estate. It's brick and mortar. I can see it, I can drive by it, I can touch it, feel it, all that good stuff. And create some really great returns, a lot better than I was getting in the stock market, right? And so, anyways, I did that first deal through the self-directed IRA, kind of like the single family. I find something I like, fast forward, I've done 6 syndications now up to this point, a handful of them here in Phoenix and one in Houston, I believe, Houston or Dallas. It's been great. And so what are some of the benefits, right, of investing in real estate? I think let's just touch on that for a second. One, appreciation, right? The asset appreciates over time. One thing nice with apartment investing opposed to single family is you can actually force the appreciation on a multifamily property. So, they go in, they renovate these units, they increase the rents, which increases the net operating income, which is how these banks loan on these type of assets, right? On a single family, it's comped around in the neighborhood. What's the house across the street going for? What's, that's a 2-bedroom, 1-bath, or 2-2, or 2-3, or whatever that is, right? What's that going for? And we're going to comp the value based on that. With multifamily, it's based on what that net operating income is. So what's that property producing an income on a month-to-month or yearly basis? Not only just increase the units. I mean, so a lot of times what that looks like is they get these business plans together and their plan is to go and upgrade the appliances. So stainless steel appliances, granite countertops, new flooring, right? New fixtures, things like that. So they make it a more livable space for the tenant. And as a result of that, they're able to charge more. They bring it up to market, and they can do other things as far as like adding gyms, pet centers, new signage, covered parking, right? Fixing up the exterior. So they paint the buildings. And of course, renovating the interiors with the upgraded appliances at that point. So, once the business plan has been executed, so typically these investments are 3 to 5 year holds. So I think it's important to note that, this is an illiquid investment. So, like for me, it was very attractive on that first one is like, hey, I can invest my IRA money that is just sitting in the bank. I can't even touch it till I'm 59 and a half without any penalties. Do the due diligence around that, but why not, right? Why not invest in something that's just going to sit there? And so the illiquid part didn't matter to me as much there, but whenever I got into, my disposable income where, that was just money sitting in the bank, I had to really make sure this is not money that I'm going to need in 2 to 5 years, right? I can put this, give it to the operator, because you can't just give them $50,000 and say, hey, Jared, I gave you that 50,000. I need this, our AC went out. I want to take $30,000 or $20,000 back to go and buy me a new AC unit. It just doesn't work that way. So, you definitely want to be mindful. This is money that you don't, that you're not going to have access to. So you want to make sure, you don't need this income to live off of. Think about it as if, are you a cash flow investor or a growth investor, right? Like for me, I'm a growth investor. I'm just trying to build my net worth. I want to compound my money. If just for example, if I'm investing $50,000 a month, once these deals start turning over and selling, they call them going full cycle. I'm doubling my money in the 3 to 5 year hold period, and I just kind of rinse and repeat. And then nice thing is too, that cash flow, as I am trying to replace my expenses as well, goes from $300 a month to $600 to $1,200 to $2,400, right? And so on and so forth. Next thing you know, I'm getting $5,000 a month on a handful of investments that I'm invested in. So I think it's definitely important to figure out, are you cash flow or growth? So, and cash flow investors typically they need the money. They're living off their cash flow, right? So they need that money. So multifamily might not make the most sense, at least the value add option, because you can get, depending on a deal, 5 or 6 to 8% cash on cash throughout that hold period. That's kind of an average. A lot of times we're seeing about 7% cash on cash, but they're not going to be like a private lender or hard money. Some of these, even new development deals, they're more growth, right? So, I actually got a buddy of mine that has a good cash flow, and I think you can get anywhere from 9 to 10% cash on cash, and it's liquid as well within 90 days. So, those are opportunities that you want to probably look at if you are a cash flow investor. But you don't get the upside, right? Like you do in the multifamily, which again, that goes back to me and me being a growth investor. I like that upside, being able to participate in the returns whenever they sell that property, right? And sometimes, the nice thing is these business plans are there, right? But sometimes the operator exceeds these, right? And you get even better returns than you were expecting. So you just never know. But it could be on the other end too. You might, the economy, depending on where we're at, or like we just saw, interest rates just rose, things look a lot different than they did back in 2021. So you always got to factor in, hey, this is a risk, right? For me, I mitigate that risk as much as possible, right? Again, recession resistant properties. I'm, investing in apartments. What attracts me to compared to a single family is you got a, say, 100-unit property. You got, 5 people don't pay the rent. You still got 95 that are, right? And on a single family, one person's not paying the rent. You're getting 100% of zero each month. So that's another benefit as well. But again, it's a risk, and worst case scenario, yeah, you could lose all your money and all your capital. So you definitely got to be prepared. And this is where that education, that due diligence. Let's go into that of know, like, and trust, right? You want to know the operator, like them, and trust them with your capital, right? So that's where, like, for me, I got on the phone with Zach, got to know him, got to ask him the questions. Once you find that operator, find the deal, they're going to send you a 60 to 100-page document, depending on the operator and the lawyers, really. But go through that, read it all. I know it's going to take some time and it's a bunch of lawyer jargon, but it's definitely good to understand that, bring questions to the operator. What does this mean? What does that mean? These are legal binding contracts. You need to know what you're getting into when you're looking at these deals. So definitely want to read those, but then you wire the money. So typically you hit soft commit once you like a deal. You got a certain amount of days to wire over the money. And then usually within a 2 to 3 month period is when your distribution starts. So the operator takes over the property, say they close, they start executing their business plan. And once they get a little stabilized and take over with either their property management company, some of them are in-house. Actually, we partnered with Lone Star Capital, and they have in-house property management. They have a lot more control over the asset, because the property manager, anybody can go out and buy real estate, but managing is another thing as well, and make sure the tenants are paying rent and keeping it up, the upkeep, the maintenance, make sure they're happy. There's a lot involved there too. So I really like the vertically integrated in-house property management. But anyway, so they take over the assets, you start getting those distributions. Now they're not going to start necessarily at 7%, that average cash. They might start at 4.5 or 5%, 5.2, something like that. And then as they start increasing the income, as far as renovating these units, that's when those distribution numbers start to go up. And that's when you just sit back. They call it mailbox money, right? Truly passive. This is one of the most passive ways, for me at least, that I found and invest in my capital without really, I do all my due diligence up front. I see the communications. Typically, I'm getting monthly or quarterly updates depending on the operator. And I just get to watch my money, sit there and, get a check or hit my bank account every month, right? And then I'm just rinsing and repeating. So that's kind of an overview of apartment syndications, primarily properties that are multifamily. I really encourage y'all. I mean, there's a lot of books. There's a book that's been referenced on this podcast by Brian Burke called The Hands-Off Investor. highly encourage anyone to read that if they're looking at getting involved in this space. And yeah, I think that's all I really wanted to touch on. I really hope this was helpful to anyone just getting started out in this space. And, again, if you found any value of this, please share it with a friend, share it with somebody just getting started out, because our goal here is just to help as many investors as we can, right? I'm a sales professional. I, want to help other sales professionals, business owners, really anybody I can to bring some knowledge to them on just some ways they can diversify their portfolios and not just have to solely rely on the stock market, these mutual funds, bonds, and things like that. And you can really create some generational wealth within 10 years. I mean, you just look at 10 years, you start doing some math. These numbers can be pretty exciting to look at as well, right? And not to mention, I actually forgot to touch on the tax benefits too, right? So you can do cost segregation, which means they're writing off anything that's detached from the property. They're doing what's called accelerated depreciation or bonus depreciation. So you accelerate that in year one. And, for example, on a $50,000 investment that I made, I got about a $30,000 loss on my K1. So I get to take that against my passive income, right? And essentially I'm paying no taxes on my income. Now, definitely check with your CPA, financial advisor, definitely run it through them. But, this has been a great wealth creation for me. Again, hopefully y'all found some value from this episode, and look forward to catching you on the next one. Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.